grinding all my life. Sacrifice, hustle paid the price. Want a slice, got to roll the dice. That's why all my life I've been grinding all my life. Look, all my life, been grinding all my life. Sacrifice, hustle paid the price. Want a slice, got to roll the dice. That's why all my life I've been grinding all my life.
Sorry guys, muted again. I gotta remember to hit that one. Um, all I said was that I'm just going to be going through CFD trading and basically explain the risk to reward profile on it, how it differs from normal shares, and what you can sort of expect from it. So, may as well get cracking into it. So I personally use the IG trading platform. There's others out there. Plus 500 I think is another big one. I haven't really used anything other than IG though, and I can't really speak on how the other platforms operate and how they may differ. But I'll just run through IG and the experience I've had with it, and you can get an idea based on that, I guess. So I'm just in the demo account. I'd strongly recommend, if you actually haven't had any prior experience with CFD trading, to run on the demo account first and foremost, because it is leveraged. CFDs are a leveraged instrument, and it's similar to stocks if you were to invest in ordinary shares on margin. So you borrow money, and you use that borrowed money to buy into the shares, and then you're basically using what your money may have been $1,000, but then you're basically using that additional money from a bank to put your exposure to enhance your exposure onto the investment, so that your returns can be much bigger. Similar to property, you go to buy a property with 10-15% deposit, and you have to borrow the rest of that money from the bank in order to get an investment that's worth $600,000-800,000 per se. And when you sell that property, say it's gone up to $1 million, up from 800,000, then you've got that $200,000 on what was originally your investment of maybe 200,000. So it's sort of similar in that way. But the leverage on CFDs are much higher. So we could be talking for every dollar you may be leveraged to $80 or $100. And I'll give you an example of that. If I just pull up a share, and we'll go US shares. What would be a good one? Let's go Microsoft. And obviously the US market isn't trading at the moment, so we won't really get live price data or anything like that, but just as an example. So if I wanted to, And also, CFDs are a way for you to short the market as well. If you actually take in the perspective that the stock price should fall, then CFDs gives you that opportunity to capitalize on that, on the downside as well as the upside. So say I expected that Microsoft shares are going to fall in the next day or two, and I wanted to take a short position on the stock, then I can sell a CFD, a contract for difference. And if I just go, if I go 1, so that 1 is just one contract for difference. So for every, let me just go 10, and we'll just set it at the current price. It's a little bit difficult to demonstrate when the market isn't open, but we'll see what we can do. Yeah, it may not want me to do it. We'll just go with this Wall Street cash. It's basically the US index, and it's trading pre-market at the moment, so we can still make a trade if we want. So yeah, you can see here for 10 contracts at $10 per point. So if we make this position, if we go into this position, a short position, at 10 contracts, it's $10 per point. So if basically the US 500 index here, if it falls 1 point, we're making a $10 profit on this. And you can see it changes as you change your contract size. So if you go 5 CFDs, then you're going to make $5 for the index falling 1 point. And then you can see also that notional figure of $118,000 odd dollars. So that's your exposure in a full like an overview sort of sense, that if you're going to buy 10 contracts, in the US 500 index, your exposure to it basically with leverage is 237,000. So that's why when it moves 1 point, which is really quite a small movement, like 1 point can happen in an instant, really. 1 point is nothing. That's why you can get a $10 profit, in a sense, in a 1 point movement. When you've got $250,000 exposure, 1 point, you can still make $10 out of it. So it's much riskier than trading shares, because yes, your profit is leveraged and your upside is increased, but also your downside is increased. It works the same way, just like property. If the property market falls 20%, that's a 20% fall on the total value of the property, not just your original investment. You're losing 20% on that total property value, and you've got to wear the cost. So same for CFDs. If it's going to go down 10%, say if we got a huge movement in this index of 10%, you're actually losing 10% on that $250,000. So that's why it can be extremely risky. Like, you don't want to be going out and doing this just out on a whim. You want to do a little bit of a test run, spend some time in the demo account, get a feel for things, understand how quickly it can move against you, how quickly you can lose money, in order to gain a sense of your risk appetite when trading CFDs. Very quickly, if you only use well, let's just chuck some numbers into this one. And So if you say put $150 at risk, your potential upside on a 3-point movement is $30, which isn't massive. You might say that, well, that isn't worth it. So what if we go 100? Okay. Now you've got $100 per point, which is massive. And as you can see here in this price movement, it shot up pretty quickly. And that stop loss, which is the point in which if it hits that stop loss, that's the point in which you sell. And then you have a limit, which is the point of taking your profits, basically. So it's a little bit difficult with going long and going short. When you go short, that stop loss is you're buying back that share, basically. But within an instant, you could have lost $1,200 within a single move with a $1,500 exposure. So that's just to give you a sense of what your risk appetite might be with this. Losing $1,200 in a couple of seconds doesn't feel great, especially if, that might be how much you make in a week. So you might want to reduce that down to, let's say, 15 or so. And then, at worst, we're going to lose $225. Well, actually, you can lose more than what you put at stake, and that's why it's really important to have your stop loss in place. I would strongly recommend having it in a position where you're not losing more than what you put at stake. And that's a really nice thing about IG, is that they have what's called a guaranteed stop loss. People that aren't really familiar with trading might know that you can get gaps in the price movement. So I might just try to find an example somewhere here. For instance, this spot just here, you can see that there's a gap right there. So say you put in an order, say you put in a long, you wanted to go long on the stock, so you bought at around this point here, and you see it falling, and you've got your stop loss somewhere in between that gap. Well, as it gaps, you're actually not going to get closed out. If it's not a guaranteed stop loss, you're not actually going to get closed out in between, because there is no one selling, and so it gaps down, and it's what's called slippage. So it will gap down and it will fill you at the next closest. So instead of getting filled at where you put your stop loss in between, it'll gap down and you might get filled somewhere in here, which can be the difference between losing $200 or losing $500, with these 1 point movements being, $15, $20, $50 per point movement. So that's the good feature of IG, and other trading platforms may have that, that they have what's called a guaranteed stop loss. So regardless of slippage or any gaps up or down in the market, IG guarantees that they will fill you at that price, and any difference they'll basically cover that. They'll charge you a small fee for you having to use the guaranteed feature, but in most cases that fee will be far smaller than if you didn't have a guaranteed stop loss in place and it gapped, and you had to wear the cost of that full gap up or gap down and selling at that position. So it's important to have those guaranteed stop losses in place, particularly as a beginner. You don't want to be losing $1,000 and boom, you're done. And I can tell you it's pretty devastating, and you probably get put off day trading, CFD trading indefinitely. It's rough. it's happened to me. It's rough. So stop losses, guaranteed stop losses are really great. You want to be using them until you're very familiar, very comfortable with the risk of trading CFDs. But yeah, so I'm just trying to think what else we might be able to go through. So the leverage, we might just do a quick demo trade here. So if I was to be watching this index here, and I'm by no means a day trader, I'm very much a long-term investing for the most part. I try to dabble in a little bit of trading, but I'm not a pro. I won't try to pretend I am. But if this was me, I'd be looking at this as we've got a little bit of an upward channel here, and it's moving up towards the top. If it broke out, well, then I might try to get in on that run. But if we see it, what's called doing the two-legged movement, which I'll just draw on here, two-legged movement, and we can see that the two-legged movement here failed. It's pushed upwards, so I would typically just drag this along and look for it to do another two-legged movement, one down, one up, look for it to go back down, and this is where you can capitalize. So we can see that it's done it before here. It's moved, the people are trading it, they're shorting it, gets to a point where the people come in, the buyers come in, and it starts to flip the other way. So the shorters want to cover their position, starts to run up, and we see that there. It really jumped up quite quickly because of the shorters trying to cover their position. And once all those shorters cover their position, and the buyer interest sort of fails, and it'll start to gradually fall away again, and the shorters re-enter. And we can see that it's starting to happen again here. And this is typically where I would look for that two-legged reversal. So I may look to go long here. And I think, and it could be completely wrong, but this is why you don't want to risk too much money. Put my limit in. I'd be happy to take profits there, and I'll put my stop loss somewhere there, $325, and so this can happen very quickly. So it already moved up quite quickly, and we missed probably a bit of profit potential there, but it's running up, and I've just got my positions here, so you can see what the status is. Profit loss, we're at 51, 81, $80 profit, 96, and it should hit my limit, and there we go. So $117 profit, boom, just like that. The two-legged reversal. The shorters got scared. We saw the price moving up, and so the shorters have to fill, and we take that run up, and as soon as it hits the price that we're happy to take profit, I was happy to take $100 profit on that one. We close out and we're done. Trade's done. We're not looking to be super risky in for the long run. I mean, that's a strategy you can play, but I'd be looking for these short-term players in it for 30 seconds to a minute, and you're done. I might have made it look very easy on that one, and I can tell you it doesn't always pan out that way quite easily. That could have kept going down, and next thing you know, hits the stop loss, and boom, you've lost $200 or $300. So, but I think that was a good example of how you might set up a play, how you have to be really quick because it can run away, and we're talking about 1 point, 2 points, 3 points movement. That's your profit margin, and within an instant it can jump up before you get your order in, and you've lost 1-2 points of that profit that you were looking to take. And now it just doesn't make sense. If you're sort of looking for that 3-point movement, you've already had 2 points, and you're trying to get in for that last point, then you're jumping in for a really high risk, low reward sort of trade on that one. So that's when, you've got to be quick, otherwise it ends up not being worthwhile. But that's sort of trading an index. I have to admit, one that's commonly traded and I don't do much of is Forex. I don't really trade the currency pairs. I just don't understand them, so I just steer clear of them completely. But I will trade US shares using this platform. I find it pretty good because sometimes I have a short outlook on a company. I want to short them, and obviously you can't short through a typical broker with shares. Like, you can't short the underlying shares directly, or I'm not aware of a way of doing it. So a CFD platform gives you the ability to do that. And if I look at one, and the play that I'm looking at, Revolve, I'm going to pull, not Evolve, Revolve. It mightn't come up on the demo account. I've got this weird thing that some stocks show up on the demo account, some stocks show up on the real account. Not sure why. I might switch accounts real quickly here, jump across to my real account, real money. So jump into the real account so we can see Revolve. Revolve Group. There we go, that's him. So Revolve is a US company, and I'm looking to probably go long on a CFD contract on it tonight. They actually report after close of the US market tonight, so in the morning, the US market closes at 6 a.m. So they're going to be reporting just after that tomorrow morning, just after 6. So I'll be looking to get into a position in Revolve probably in the early hours, 4 or 5 a.m. tomorrow morning, getting into it, and then I'm expecting, and I could be completely wrong here, and this is the risk with any trading or investing, it's you can always be educated and informed to the best of your ability, but at the end of the day, there's always going to be a little bit of guessing in it and estimation. If everybody knew for sure, there would be no way of actually making money out of it, because the stock price would always be where it's always, whatever its current value is at, and everyone would be fully aware of what it's worth at any given moment. So you wouldn't have people willing to pay more for it, and you wouldn't have people selling it for less than what it's valued at. So that's why there's always some risk to an investment, and yeah, you can't be fully sure on it. But I'm expecting, could be completely wrong, I'm expecting that Revolve, which is and I might be able to actually pull it up here for you. Revolve. So it's a clothing brand, women's clothing. They're mostly online, and they really direct their advertising through Instagram influencers. So they're really aiming for that younger demographic through the use of Instagram influencers, and gaining traction through that means. And I think, gradually, and we've seen it already, there's a shift from the old bricks and mortar, come into the store, have a look around, you like the look of that dress, buy that, try it on, take it off the shelf, away you go, and walk out of the store. We're seeing a move away from that to online retail just being the go-to. People aren't so caught up in, I can't try it on. because most of these companies have really good return policies. So it's in most cases a win-win for people when they're shopping. If you don't really feel like going out, or if it's not stocked in your local store, you look online, you buy it, you get it sent to you, you try it on. If it doesn't fit, or if it isn't quite what you expected, you can send it back, no worries. But in this world of like social media platforms, Instagram influencers are the biggest advertising these days. It's so many eyeballs are on that, and when you can get someone that has a lot of influence, and people sort of aspire to look like them, be like them, use the same products as them, by advertising through that avenue, I think Revolve has had a really great uptake in their business. So I'm sort of expecting that because of the whole coronavirus situation, that that they will be the beneficiary of that. More people shopping online, more people scrolling through their Instagram feeds, seeing what other people, seeing that influencers wearing stuff from Revolve, and putting the links in for shopping through it. So I'm expecting that a lot of people have priced in that they wouldn't do as well because they do have physical stores, but I think people will be surprised that to the upside, that they've actually done pretty well during this this crazy situation that we've been going through. Now, in saying that, the stock price has rallied already. We have seen a pretty big movement, already trending upwards. The last week, I think it's jumped about 30%. If I grab the old measuring tool here, so from the bottom here up to the top, and it's pulled back down. So about 46% move to the upside already in the last week, and from its lows, it's nearly doubled. So we're probably not getting it very cheap, but I'm trading on the short-term movement. I think it'll really pump up quite quickly on the earnings release, and what it does a week, 2 weeks later, I don't really care too much for. I'm wanting to see a quick bounce out of it on a one-day turnaround and get out of the position and be done with it. But my sort of mindset on this is looking at it from a longer perspective. We've had it up at $20 a share before this whole Rona situation, up around here, around $20, and we're probably, if I pull out the measuring tool again, we're sitting at about, still, it's shaved 50. I don't think that worked properly. What am I looking at here? Still down about 30% from its high before this whole crazy situation hit. So I wouldn't be surprised if we get a quick little 5 to 10% bounce out of the stock on earnings, and I would then be looking to close out that position the next day, as soon as the market opens the following day. You can't trade the stock while the market's closed, but it will jump after hours, hopefully, and then as soon as the market opens, I'm hoping that it pops up a bit more, and we just close out that position, boom, walk away. Maybe $200 or $300 profit out of only being in a stock for, if you don't count the time in between the market being open, only being in the stock for maybe an hour or so. So that's the move that I'm looking to do. But if you have any questions, guys, on the CFD trading, just chuck it in the comments, and I'll be happy to answer it right now for you. But as I was saying, like CFD it's a very risky, much more risk to it than just trading typical shares, because of the leverage. And this is not something that I would be doing on a daily basis. I'm not doing this on a weekly basis. It's mostly around earnings when you do have that catalyst for a big move, and you can profit off a 5% movement. And typically for me, I find earnings are a little bit easier to gauge fairly well how the market will respond to it, particularly once you've had a week or two of earnings reporting previously. If you start to see how the market is responding to the earnings releases, and particularly in the same industry or the same sector that the company that you're wanting to play, once you sort of get a gauge of how the market is responding to it, it's, I find it a lot easier to have a fairly well informed, it's still a guess, but a well informed guess at what the stock may do when it releases its earnings reporting. So it's something that I'm, only doing every now and then, just as a, little bit of fun, but also if it makes sense, if you have a really strong feel towards a stock and how it's going to react to its earnings reporting. If it's a stock you've been following quite a lot, and you have a trading thesis behind it, you have a little bit of a reason to it, and you feel pretty strongly about how it's going to react, then you may as well, chuck 150, $200 at it, and you may double your money or 50% gains. I did, if you were following on the Instagram, and I may have mentioned it in a previous video, I did it with Wayfair, an online furniture retailer. I did it with them a couple of weeks back, and I think I put about $150 on it, and just about 3x'd my money on that one. So it's a really good way of making a bit of money on small movements in the market. And you can lose money. You can lose money just the same, and that's the risk you have to take. With a higher reward comes higher risk. But yeah, guys, if you have any questions, let me know. Also, even after this video, if you're not really wanting to chuck it on the comments of the video, you could always message the Facebook page, message on the Discord. If you haven't joined the private Discord group already, join that. The link is in the description of this video, and you can flick a message to me in that one. Plenty of avenues to reach out, get some input. If you're someone just starting out in investing completely, so you haven't got any broker set up, you haven't invested in any stocks previously, then I wouldn't really recommend going straight to CFD trading, just because if you haven't got the fundamental understanding of assessing a company and how it may react to earnings, what to expect from a company on earnings, what is typical to see from a company around earnings, if you haven't had that time in the market to get a feel for those things, then you'll just get wrecked by CFD trading. Like I'm telling you, you'll lose your money very quickly. If you do make money, you might make some money on getting lucky once, but I can tell you, if you're not informed and you haven't had the experience, you will lose that money very quickly. I think it's about 70% of traders in CFDs lose money. So it's not something you can just get lucky on repeatedly. It's even people that are informed, that have been in the market for a long time, it's something that they've been doing regularly. Those sort of people still lose money, and some actually may never break even. They do it on the side, and it's they may not make money. They may not make a profit as many times as they make a loss. So it's a high risk thing, and if you're someone just getting into investing, I would not recommend it at all. I would strongly recommend you go set up a brokerage account with someone like ComSec, NabTrade, any of those brokers, and buy a normal stock and get informed on the stock market that way. Start reading earnings reports, get familiar with the fundamentals of a business, revenue, NPAT, EBITDA, all those different metrics. Learn through that. Don't just jump straight into CFD trading where it's all just guessing if you haven't had that background previously. So on that note, guys, I'll end it there. I hope that this video is informative in some way. If you've been looking at doing CFD trading in some capacity and you just haven't jumped into it, you don't know where to start, IG is a good place, plus 500 possibly. There's others out there. But hopefully this video is like giving you a bit of a baseline as to what to expect, how you may go about it, and hopefully it gives you the baseline to get trading and make some money, hopefully. So guys, thanks for joining me. I'll see you in the next video, and have a great night. Peace.